India's entrepreneurs have emerged as key drivers in India's development, as they have fueled innovation, generated employment prospects, and by doing so have propelled economic advancement here in India. Through their bold endeavors and transformative initiatives, entrepreneurs are actively molding the destiny of India while bolstering its global competitiveness. In today's edition of SBI Mutual Fund presents Invest Smart, Mutual Fund ke Sath, partnered by ET Now, we delve into the art of astute investment strategies designed with entrepreneurs in mind. Our distinguished guests for this exclusive session are Amit Gupta, Executive Vice President and National Sales Head Institutional Business at SBI Mutual Fund, along with Kalpesh Usher from Full Circle Financial Planners and Advisors. Amit, let me start with you.
Yeah.
You know, when we were conceptualizing this entire show, it is very often that entrepreneurs, how should they be going about managing their risk? They also want return. Their key focus area is their business for sure, but they also have something in the back of their mind to how to participate in India growth story. We all are reading headlines. Global companies are wanting to set up business in India. So not to miss out this opportunity and still to keep an eye on their core business as well. And that is why we thought we should have this special show.
Very, very important.
So talk to us about why financial planning is important for entrepreneurs, and they should give it a very focused thought about it and still not mix the business into their financial planning. Why don't you start?
Very, very relevant question what he mentioned, and thanks for having us here. And I believe at this point of time, financial planning is very much relevant for every set of investor, more so the entrepreneurs, because most of the time you are stuck up into your business in terms of how do you scale it up, how do you reach more and more customer and become profitable. At the same time, you have to participate in the India growth story which is happening. So what we suggest, for every entrepreneur, you should look at planning, financial planning in two aspects. One is the treasury management part, where you need to manage the treasury operations for your particular business, of creating liquidity and making sure as and when you require some kind of a liquidity, there is a ready-made liquidity which is available to us. Similarly, on the promoter side, you have to do a financial planning where the investment will be for a longer term, ideally participating into the equity market through equity mutual funds and all. And there one should look at, taking out at least 50 to 20% of your profits which you are making every month. And there has to be a regular continuity. SIPs are the best bet. That is something which you should look at, and a proper combination between your treasury planning for the business part and investment planning for the promoter part is very, very critical.
Mm-hmm. Kalpesh, coming to you, you are a professional financial planner. A lot of people come to you. How do you differentiate between financial planning for somebody who's in service versus somebody who's managing their own business? Because it is also about risk, and the guy who's already running an outfit of his own, a firm of his own, is managing risk on a daily basis. So how do you differentiate?
Yeah, so the field of financial planning is so beautiful. I'm talking about the hardcore personal financial planning textbook style. Okay, is that this is a thing which is applicable to everyone. Only thing you have to put the word is personal, and when you add the word personal to it, it means it's not general. So everybody's situation is dynamic, and you answered the question itself, that an entrepreneur himself, by being an entrepreneur, is taking a risk in his own business on its own. So he knows that he's already into a volatile type of an income generation thing for himself, unlike a salaried person who has got a steady set of income and he doesn't have to worry about it at the end of the month. His income is not going to fluctuate regularly. So that element of risk for which he gets rewards and losses both is already inbuilt, is imbibed in the entrepreneur himself. So it starts with that. Second, most important point, which I would like to say, is what differentiates personal financial planning between entrepreneurs, individuals, and salaried people is that there should be a demarcation. Do not mix your company or your entrepreneur thing with your personal finance.
Amit, you travel across the country in part of your business and meet all kinds of people. I would understand specifically by an example. Suppose an entrepreneur comes up to you that the country is doing so well on economy front. I have a flourishing business. Monthly and quarterly cash flows are very good. How should I take a decision on how much of those cash flows I should pay myself, which Kalpesh was talking about, and make a stream of systematic investments on top of that? How much should I retain it in my company so that the company's growth is also not? How to take that decision?
So yeah, Vijay, and we keep on meeting many startups and all, and have been advising them both on the company side as well as the promoter side, what Kalpesh mentioned. So it all depends on the evolution stage of your company. If your company doesn't require any kind of a regular cash flows to be deployed there, maybe all the monies which you are making as a profit can be invested on the personal side. You can take 100% of your profits and can invest into your personal financial planning. If the company requires some bit of money to be for expansion purpose and all, maybe then ideally people go 50-50. 50% is being retained into the company for future needs, and there, as I mentioned earlier, you need to do a treasury management where you invest into those kind of strategies which are very safe. They give you optimum return which are in sync with your savings bank or some bit of FD returns and all, while personal finances are being managed depending upon your risk appetite, your return expectation, and what kind of a volatility intermittently you can withstand. The way Indian economy is doing it, we have been suggesting that if you have monies which you can part for 5 year plus, your money should be invested into equity. And there one has to have a little longer time frame in terms of the investment horizon. One should stagger out their investment. SIPs are the best bet, which we suggest going into equities. It is called dollar cost averaging or rupee cost averaging, whichever you call it. And there you choose 3 or 4 good funds from AMCs which have a proven track record. There you can go either for a combination of some multi-cap, flexi-cap and large cap. And there have been schemes which have a track record, Ajay, of last 20 years, consistently generating returns in excess of 12 to 13%, and a consistent compounder. So one should choose those 3-4 schemes through advice of your financial planner, advisor who can suggest to which all strategies you should go for. And that kind of a money you should commit for a longer term. So the financial planning should be as simple as it can be. It should be very personalized based on your risk return expectation, and it should be always consistent. And to answer your question, I believe whatever money which you can park, which your business doesn't require, that money should be invested into mutual funds over a longer term.
Amit, I have a follow-up on that one. A lot of time in our discussions, sometimes we emphasize or overemphasize on equity. And whenever financial planning is spoken about, it is understood that I think they are talking about SIP into either equity mutual funds or direct stocks, etc. But for an entrepreneur who also needs to take into account unforeseen risks which the business may require going forward, what are the other options to keep money parked outside of the balance sheet or the P&L of the business, but still somewhere in sight? So beyond equity also, what are the other options which they should also take into mind while asset allocation?
So that's a very, very relevant question. So when we speak about mutual fund, invariably we think that everything is related to equity, which is not the case. A mutual fund in itself is not an asset class. It is the medium or the vehicle through which you invest into different asset classes. So we have schemes which invest into debt mutual fund, right from your overnight money to your 10-year, 15-year GSEC money also, and in between corporate bond and different tenures of papers on the corporate bond side. Then you have equity. We have gold-based funds also, gold ETF, gold index fund and all, which you can look at. And now there are real estate funds and all which are coming in. So depending upon what kind of a allocation you are looking to put into different asset classes, we have mutual fund strategies which can help you in taking those kind of a exposure.
Kalpesh, let me come to you now and touch upon one of the most important factors for every investor and entrepreneur in particular, because bulk of the entrepreneurs are under 35, under 30, some are under 25 as well. And over a period of time, as you just also mentioned, that longevity of individual versus longevity of the business. Why is it important to start financial planning right at this when you're starting off in your career or your firms as well? Why is it important? Because over a period of time, it is difficult to take out money, or what exactly happens?
Okay, so I'll surely answer that, but if you allow me, I would like to add a little point to what Amit mentioned and put it in a little bit of a non-financial term. He's explained all the technicals very well. For entrepreneurs or for individuals, in financial planning parlance, what we call is creation of a contingency fund. That is an emergency fund. Now that emergency could be anything. For an individual who's working, it could be a job loss, it could be a medical emergency. For an entrepreneur, it could be fluctuations in his business or some tax liabilities. That money you need on the spur of a moment in 24 hours. Now, where you park your money is more important, and exactly the points on which he touched upon should not be in an instrument which is illiquid, which should not have an exit load or anything which cannot come to you in 24 hours. Returns in a contingency fund is not of importance. It is for immediately meeting that need so your life doesn't come to a standstill. In personal financial planning, you should have 3 to 6 months of your expenses kept aside in a contingency fund. And the instruments which he mentioned are the apt instruments, which could be a debt liquid fund or an overnight fund or these small ultra short duration funds where the returns on an annual basis is 5.5–6%, no problem. But these funds will be your savior. And there's no better testimony than this, than what we as financial planners encountered in COVID. All those people who had contingency fund kept aside could lead their life easily for the next 6 to 12 months. Without breaking the actual investments, without panicking, without taking a loan. And on the contrary, as it is, they were sitting there, they could also invest. Because their expenses had come down. So that was the testimony. The contingency fund became saviors. So everybody who's looking at being an entrepreneur or an individual should set aside 3 to 6 months of his expenses, either in a bank FD, no problem. Nobody's going to call you foolish for that much amount. Or a liquid fund, or in a simple savings account also. But you know that money is at your beck and call and not at any other thing. So this is what I wanted to touch upon.
Also talk to us about the importance of starting early.
Yeah, so I'm coming to that aspect. Now, starting early, I think, there's nothing more better to explain than the power of compounding. Now, be it an entrepreneur or be it an salaried person, ultimately when he, dons the role of an investor, I think he will understand what starting early means. Now, I'll just give a simple example out here. It'll be simple enough for everybody to understand. Let's keep an hypothetical amount of say 5 crore, which a person would require when he retires. A hypothetical, which is not a small sum by any yardstick, okay? And assume that a 30-year-old person would say that I would want to invest for the next 30 years in, say, any instrument, I'm not naming it, which would give me 12% CAGR, which is very moderate type of a return I'm quoting, 12% CAGR. And he does calculation, he would require approximately to do 14,000 rupees per month to reach a corpus of 5 crore when he is 60. Okay, 14,000, pretty reasonable for a person at the age of 30 to do that. Another smart guy comes saying that for whatever reason, that I'll delay it by 10 years. Okay, now the calculation would move up that he's got 20 years to invest to reach that goal in of 60 at 5 crore. He would require an SIP of 50,000 rupees per month, continuously growing at 12% to reach to an amount of 5 crore. It's gone up almost 3.5 times. And some person late in his life wakes up at the age of 50 and says, I want to reach 5 crore. Any guesses how much would he need for the next 10 years? It's approximately 2,15,000 per month.
Just imagine, that's the opportunity lost.
So it's just a question of setting your mindset, getting your personal finance in order and starting to invest even any amount. This is just an example I gave on an approximation basis. This doesn't lead to anything, but it is a fact. And starting early has got its many advantages. So when you start early in your career, you're easily able to set aside money because you don't have liabilities, you don't have responsibilities in life. Second, the concept of asset allocation is very necessary. Because you might be having, and as financial planners, nothing is more important for us than financial goals. Because for me, anything what you earn or spend should have a purpose. It's not that anything is in thin air and you're just trying to outbeat the market and all your goals are going by in life. So if you have set a target of achieving, say, 50 lakh rupees, and you find that the markets are undervalued and you still, or overvalued, whatever, and you don't go and attain that goal, I think you've not lived a life.
Out of the viewers sitting here, and of the so many viewers among, watching us on the television, the entrepreneurs, the young, old, mid-age, everybody, if there are, out of your 20 years of rich experience in this space, you have analyzed a lot of data. If there are few things, couple of things, what is the message you would like to give entrepreneurs in their financial planning who are starting off, those who want to, take a review their own financial planning, and the ones who have missed out maybe, but still completely not lost out? What are the 2-3 messages would be?
Sure. So I will take from where Kalpesh left, and very, very relevant point what he mentioned. First is about the asset allocation. So whenever we speak about portfolio, we have to have a comprehensive look rather than being overboard on any asset class. We need to understand what is the purpose of our investment. And there we need to do a goal-based investing. As he mentioned about the contingency fund, in contingency fund you cannot take risk. The idea is to generate optimum return. Then we have, based on different targets into our lifestyle and life, it could be for your children's education, their marriage, your retirement and all, and there has to be a investment based on these targets and all, these goals. So these goal-based investing is something which we suggest. There has to be a proper asset allocation within your portfolio. There has to be a proper combination between equity, debt, some bit of FD, insurance, and maybe some bit of gold also. I would like to give an analogy out here, like the way we have our Indian food, which has different dishes. A carbohydrate is there, a thali which we call in the Indian thali, and through which we are always fit. The time we move to a fast food, it is always dangerous for your health. The same way we have to do our financial management. We have to have a certain zing in terms of the PMSs which you were speaking about, a decent portion into equity, but consistency will come through your debt, your gold, and also there has to be a mixture of everything which takes care of your risk and also meet your return expectation. And purpose is very, very important. Goal-based investing is very important. And just to answer, when investor is starting their investment journey, I believe discipline is something which is most important. You need to define that what are you looking for from your investment. Mind you, we also have to be very clear that there are no instant gratification. There are no way to become riches overnight. There has to be a disciplined approach. You have to be very consistent in terms of your investment for a longer term, and that is how you create wealth. Wealth creation is something which can be only achieved through proper financial planning. So you need two things. First, a proper financial advisor who understand your financial need. They are like a financial doctor. And then based on your cash flow requirement, based on the kind of money which you are generating, the kind of liabilities which you have, they will generate a good proper plan. And as an investor, we need to stick with that plan. Entrepreneurs have a higher responsibility because most of the time you are devoted in terms of scaling up your business. The time you start putting your brains behind how much money you generate, other than that, directly from market, you will be not able to do justice either with your business or with your portfolio. So a business should be focused by the entrepreneur and let the money being managed by the professionals, and that is what we do day in, day out.
Kalpesh, what would your message be?
Make a statement first that money is made every day, wealth is created over a period of time. Understand that concept. When you say that I made a lot of money, you're making it every day. But when you say wealth, punji, you create it over a period of time. For that, I think first and foremost, after whatever experience we've had and interacting with people and yet learning, I always call myself a student, is that avoid making financial mistakes. Because inaction in finance at times is better than wrong action. And many people today, it's a concrete jungle in the world of finance. Okay, there are people, there are hawks eyeing on you with your wealth and almost on the verge of helping you make mistakes, Okay, stay away from that. Understand your own profile. Understand in which stage of life are you right now. Everybody cannot beat the market, and you don't need to beat the market every time. What you need to understand is your own financial profile, get a handle of what you want in life, your goals. For some, like asset allocation, again, though equity is the most preferred rate, but at a stage of life, temporarily, for somebody, debt might be the best instrument to help him overcome that crisis or whatever it is. And then you're back on the track and you're back to equity. So my main point here is, do not make financial mistakes. Get professional help if you all can, get it at, good, I think with a good advisor or somebody. And more importantly, start the process. Do not procrastinate. Aaj karenge, kal karenge, do not do that. At least get on the path and get on the right path, identify your goals and stick to it.
Right. Amit, Kalpesh, thank you very much for your valuable inputs. Let's have some questions from our audience then.
See, the life of an entrepreneur is very challenging and tough, and especially for the first generation entrepreneur. So when we talk about the consistent investment on a regular basis, see, the income is volatile, so it gets very difficult. See, I have missed few of my LIC policies premium because that few months I was not making that enough income. So how should one manage this volatility and make sure that your policies are intact and your investments are going on?
In personal financial planning, I think as in Hindi they say, "Sab dukho ki ek hi dawa." Make your cash flow. And what I said, pay yourself first. So what I mean here is that once the entrepreneur decides that this is the amount which I'm going to keep for myself, that's his take-home income on a monthly stroke annual basis. And that is a starting point which he has to build his entire personal financial profile on. So either you formulate a certain structure with your own company that this is my income, this is my profile, and I'm going to live within that. And in that, if you feel that you can't afford certain things, so be it, make that supreme sacrifice.
Amit,
Yeah, sorry, just to add what Kalpesh mentioned, as an entrepreneur, I will also suggest that you should put a certain salary which you should take. It could be any nominal amount, but there has to be a certain discipline in terms of taking that salary. In addition to that, business goes through different cycles. So whenever the going is good, at least set aside that kind of a money which you are making disproportionately. And through the systematic transfer plan, you can invest either into equities and can also play your insurance premium and make sure that everything is taken care of.
My name is Bharat Mehta. I am connected with the fashion and lifestyle business, and we have been operating pan-India. So my question is, in today's environment, there are a lot of schemes and a lot of mid-cap, small-cap, flexi-caps and all that. Now, once we are entrepreneur, we are working 24/7. What I want to know is that how mutual fund, if it is mutual fund sahi hai, so how it can take care of my problems and how I can be better off in my investment. Thank you very much.
So, very relevant point, and which is what we keep on mentioning, that the portfolio management should be left to professionals because it is our 24/7 job. As I mentioned, that you need some financial advisor because based on your return expectations and the cash flow requirement which you have, they can design a plan. Now, mutual funds are product companies. We have strategies for every set of investor, right from, and when we speak within asset class, we have right from large cap to small cap, we have plethora of funds. Gradually, we are also launching some solution-based strategies, like we have the children benefit fund, wherever if you have your minor kids and all, you can invest in their name. We have retirement funds. But that doesn't take away the importance of a financial advisor. So based on your return expectation, and this is a point which I have been reiterating time and again, and the volatility which you can undertake, they can construct a portfolio for you. My only suggestion and piece of advice has been that rather than looking at the fund which is topping the chart, because there are no chart toppers for an elongated period, you look at the consistent fund which has been doing well across market cycles.
I'd like to add one point here. I think we missed out during the entire conversation. For an entrepreneur to get himself adequately insured through a term plan
is very, very important.
Very, very important, because his personal family or his personal finances, his liabilities, everything at least is protected through a very adequate term plan. Not any other insurance plan. I'm not talking about the insurance cum investment plans. A pure adequate term plan, because if that is type of protection which he can get and if there's a fatality which happens, at least his financial loss is covered by the family.
So that's very important. Gentlemen, both of you, thank you very much for coming by today in our studios for this conversation with the entrepreneurs and how they can actually ace their own personal finance game as well. And all of you, thank you very much for turning up in our studios today.
Thank you. Thank you.
Thank you very much.
Thank you very much.